unrealized profit in closing inventory, and I'm going to do a very straightforward, simple exercise just to show the basics. Okay, so we've got an example which is parents sold inventory to subsidiary for $500,000. The inventory cost the parent $300,000, and at year end all inventory is still on hand. So basically we've got a situation where we've got the inventory costing $500 for the subsidiary, but originally when the parent bought the inventory it cost $300. So therefore there is a profit of $200,000. Okay. What we generally find that when we have this type of adjustment, consolidation adjustment to do, we simply will debit sales, we will credit cost of sales, and we will credit inventory. Okay, obviously you can do that as two journal entries. You can debit sales, credit cost of sales, and you can then debit cost of sales and credit inventory. So I'll show you both of those journal entries. Okay, obviously there's a choice. Okay, so we're going to look at this question here. Parent sold for $500,000. Okay, so parent has $500,000 sales that they've made. Basically the sales is going to be debited with $500,000, and I'll explain to you just now exactly why. The short way of doing it, okay, how much did it sell for? $500,000, debit sales. The next thing that I'd go to would be credit inventory. What's the unrealized profit in closing inventory? So because at year end all inventory was still on hand, we're actually going to have to get rid of the full profit, which is $200,000. So the full profit is an unrealized profit because of the fact that it has not been a sale outside of the group. So it has not been a sale outside of the group. This sale took place inside of the group. Therefore, the profit that was made is considered to be an unrealized profit. It can only be realized when it's actually been a sale outside of the group. Okay, so therefore we're going to credit inventory with $200,000, and we're going to credit cost of sales with a balancing item, which is obviously $300. Okay, just to prove to you that what we've done is correct, I'm going to look at the worksheet. Okay, so basically we've got sales of 500. For the group, we don't want to recognize the sale at all, purely because of the fact that the sale was made within the group. Therefore, we don't recognize the sale because the group can't recognize a sale that has taken place within the group. Okay. Your inventory is going to be sitting in the books of the subsidiary, and the inventory is going to be sitting in the books of the subsidiary at $500,000. Okay. What do we want the inventory to be in the books of the group? We want the inventory to be $300,000. Why? Because we want it to be reflected at the amount it originally cost the group. So when it originally came into the group, which was when the parent bought the inventory, it cost $300,000. Okay, the fact that it's been sold within the group, we don't want to recognize the new cost because that sale is not going to be recognized by the group. Okay, so we want it to be at the original cost to the group, which was $300,000. So basically, so far we're going to, obviously, our adjustments, our consolidation adjustments, we want this to come down to 0, sales to 0, so we're going to debit. Okay. We want inventory to come down to 300, so we're going to credit. And cost of sales, we're obviously going to have that sitting at it cost, obviously the inventory cost the parent 300,000, so therefore cost of sales will be 300,000 here. Okay, and we want the cost of sales to be 0. Why? Because we don't want to recognize the sale. So if we don't recognize the sale, we have no cost of sales. Okay, so we simply are going to credit cost of sales with 300,000. Okay, so basically we've got the sales down to 0, cost of sales down to 0, and our inventory is sitting at the original cost of the inventory to the group, which is 300,000. Okay, relatively straightforward. The tax side of that, we're going to have debit tax expense, and actually, we're actually going to be crediting tax expense. So I'm going to put that there, and we're going to debit deferred tax asset. Okay, why are we going to credit tax expense? The reason why we credit tax expense is because the parent pays tax in its own individual capacity. The subsidiary pays tax in its own individual capacity. The group simply adds the tax expense. So we'll add, as it normally does, to get the group figures. Obviously, it also has to take into account any adjustments. Okay. So, for example, 500 plus 0 minus 500 equals 0. 300 plus 0 minus 300 is equal to 0. Okay. Tax expense, we're going to take the tax expense of the parent, tax expense of the subsidiary. We're going to make any adjustments, and we're going to get the group figure. Obviously, your tax expense parent, they would have recognized a profit here of 200,000. Okay. This profit, which was made by the parent as an individual company, is not recognized by the group. So therefore, because we've actually taken that profit out, we've got 0 sales and 0 cost of sales, there's no profit, we will then have to obviously reduce the tax expense. So when we add these together, we're then going to have to reduce the tax expense because the group tax expense obviously should be lower because they haven't recognized that intergroup profit or intercompany profit. So therefore, we know that the unrealized profit is, as I say, that figure there, 200,000. So the unrealized profit, as I said, what is an unrealized profit? It is simply a profit which has been made within the group, which is not realized in the books of the group because it has not been a sale made outside of the group. Okay, so we haven't recognized that profit. We have in fact decreased sales by 500. We have decreased cost of sales by 300, and so therefore the profit has been reduced by 200 for the group. When we add up the figures, we've simply reduced the profit for the group. Okay. Therefore, we're going to simply multiply this by the tax rate, which is currently 30%. So 200 times 30%, we will get 60,000 and 60,000 deferred tax asset. Why deferred tax asset? Because as far as the group is concerned, this amount of tax which will be paid by the parent is considered to be a tax which has been paid too soon. Okay, so deferred tax asset is generally can be considered to be similar to a prepayment of tax. Okay.